Beyond estate taxes, the new role of revocable trusts. Most people assume estate planning starts with avoiding taxes. In 2026, that's no longer necessarily true. Because one of the biggest changes in modern estate planning isn't a new trust strategy, it's the federal transfer tax landscape itself. Beginning in 2026, the federal estate and gift tax exclusion increases to approximately $15 million per person, indexed for inflation going forward while portability remains available for married couples. For many families, that means the conversation is shifting, not away from trusts, but toward how trusts are used. And that's where revocable trusts remain the foundation of modern estate planning. A revocable trust is often the primary planning vehicle in Arizona and throughout the United States. During life, it centralizes ownership, simplifies asset management, and provides a framework for incapacity planning. At death, it helps avoid probate for properly funded assets, and can continue operating as a long-term platform for managing and distributing wealth across future generations. Importantly, a revocable trust does not automatically reduce estate taxes. Its primary role is administrative and structural. The tax planning comes from the provisions built inside it. And in Arizona, revocable trusts are especially powerful because Arizona imposes no separate estate tax, inheritance tax, or gift tax. As a result, planning is largely driven by federal law, which brings us to one of the biggest themes in estate planning today: basis planning. Under current federal law, assets included in a taxable estate generally receive a step-up in basis at death. And in community property states like Arizona, both halves of community property may receive a basis adjustment at the first spouse's death. That can dramatically reduce future capital gains taxes. This focus on basis became even more important after IRS Revenue Ruling 2023-2 clarified that assets inside an irrevocable grantor trust do not automatically receive a basis adjustment unless they are included in the grantor's taxable estate. In other words, grantor trust status alone does not create a step-up. As a result, modern revocable trusts increasingly incorporate flexibility. Many plans now include portability provisions, disclaimer options, QTIP elections, and other post-death planning tools that allow families to make decisions after death when actual tax circumstances are known. For example, a disclaimer provision may allow assets to move into a credit shelter trust if future estate tax exposure becomes a concern. A QTIP election can preserve the marital deduction while potentially creating another basis adjustment later. And portability planning allows a surviving spouse to preserve unused federal exemption amounts through a timely filed estate tax return. The appropriate strategy often depends on the size of the estate. For families between $1 and $5 million, the focus is typically probate avoidance, governance, and basis efficiency. Between $5 and $15 million, planners often model future growth and preserve flexibility through portability and disclaimer planning. Above $15 million, transfer taxes can again become a meaningful consideration, requiring additional strategies such as GRATs, sales to intentionally defective grantor trusts, dynasty trusts, and charitable structures. For ultra-high net worth families, planning may also involve family-limited partnerships, private trust companies, charitable lead trusts, charitable remainder trusts, and multi-generational GST planning. Arizona offers additional opportunities. The state's community property rules can significantly enhance basis planning, but planners must also be mindful of issues involving dynasty trust duration, multi-state assets, and proper trust administration. Ultimately, the most important takeaway is this: the role of the revocable trust has not diminished in 2026. If anything, it has become more important. Not because it eliminates taxes by itself, but because it provides the framework that allows families to adapt as tax laws, asset values, and family circumstances evolve. Today's best estate plans are not built around a single outcome. They're built around preserving options. Because when wealth spans generations, flexibility is often the most valuable asset of all.